All right, my friends, this is going to be a thing of beauty now when it comes to the reasons you need a Roth, because we're going to start showing you what happens when you do a Roth as opposed to just sinking all your money in the traditional. So if you haven't watched the previous, I don't even know how many, 6, 5, 4, something like that videos, go back from the start. You got to see how we built this up to show you how it really kicks in now with a Roth IRA. So again, just to summarize, we got a couple, husband and wife. They're both 50 years old today, all right? They make $100,000, so $50,000 for the husband, $50,000 for the wife, completely gender neutral here, by the way. And now they each have $150,000 in their current respective traditional 401k, completely deferred. And they expect to get 7% rate of return on that money. So they come to me and say, Josh, we saw you on YouTube. You're just the best. Tell us what to do. And I say, well, I think you should defer. Certainly take advantage of the match, but I think what you really should be doing is building up your Roth 401k. And they're like, whoa, Scanlon, crazy talk. If we do that, we're going to end up paying $2,349 a year more for this, who knows if there's even going to be a tax benefit in the future, because we could be in a lower tax bracket than we are today. And I said, let's run the numbers, and I showed them this YouTube video, and now I'm going to close the deal right here. And again, I don't care. You can do whatever you want to do. It doesn't matter to me, but now you know the different perspective on this, because this is what happens. My taxes are here today. I think my taxes will be there in the future. Thus, should I do a Roth? And there's so much more than that, man. It is so much more. Again, can't just compare apples to apples. You got to compare apples to oranges, to peaches, to apples, to strawberries, to watermelons, to tangerines. Because the Roth, the taxes you pay today, has huge benefits down the road for other things too. Just go back to the other videos. All right. So for some reason, I was able to convince them. And again, I'm not in the business of convincing people. Do whatever you want. I don't care. But I said, look, why don't you do your own $10,000, because they're each deferring $10,000 of their own money into their 401k. So why don't you all do each your $10,000 into the Roth 401k component as opposed to traditional, all right? And on top of that, you're still going to get your $4,000 match. It's an 8% match here. You're still going to get that match. That match doesn't go away, but that will go into the traditional, the pre-tax, but your Roth contributions will go into the after-tax, which means you're going to pay a few extra $1,000 a year in taxes from now until when you stop doing this. And they said, let's see some numbers. So I said, okay, $150,000, $4,000 a year going in. After 10 years, at a 7% rate of return, your tax deferred will be or I say in this case taxable, because it's going to be taxed, but we'll just say tax deferred. It's going to be worth $350,000 for you, Bob, and for Jane, it's going to be worth $350,000 for you as well. Nothing changes, all right? They're going to be the exact same amount. $150 start, your payment is $4,000 a year. That's what your employer is putting in. At 7% rate of return, after 10 years, it'll be worth $350,000 each. Now, your $10,000 that you're each contributing to your Roth, again, at the 7% rate of return, will each be worth $138,000 after 10 years. We're putting $100,000 in, or yeah, $100,000 in. We get 7% rate of return, so each grows to $138,000. All right, so now you're 60 years old. You got $700,000 in your traditional, your tax deferred, and you got, what's that, $280 in your Roth IRAs, give or take. And you say, you know, we're going to quit work and I don't know, whatever. Maybe you got an inheritance or something, you're just done. So you say, we're going to quit work and we're not going to touch this money until we have to, which would be at 70 years old. You're still getting a 7% rate of return. So this $700,000 grows to $688 per, what's that, about 1.4, yeah, roughly 1.4 million. So $700,000, it doubles because we're getting that 7% rate of return. The rule is 72. The nice thing about using a 7% rate of return, we know it doubles every 10 years without any additions or subtractions. As long as it sits there, if you're getting 7% rate of return, you know in 10 years you'll have doubling of what you currently have. The Roth, the same thing. They're both going to double. So in 10 years, we'll have the Roth each worth roughly $300,000. So in this case, we'll just say $700,000 for simplicity on the tax deferred, taxable, and $300,000 on the Roth. So we come back up here, and that's where we stand. All right, so now they have to start taking required distributions. Now, I didn't run over the whole litany of the RMDs for these guys, don't really need to, but I did want to show you what happens when they hit 80. So at 80 years old, all right, so a couple things happen here. There are now a couple things going on. You might wonder, there is a difference between this account at 60 in terms they both have 488 in that account, whereas before they had 502. And the reason for that is because that other time when they did the deferral, because they're saving money on their deferrals going to the traditional account, they didn't have to pay that we'll just say $2,500 a year extra in taxes. We put that into a side account, and that money was growing. So this is 488, whereas the other way was 502. Just in case you're wondering, we didn't miss that. We're just saying in this case, we don't have that side account, so we don't have that money growing for us because it had additional taxes to that, all right? So just in case you're wondering, like, whoa, that's not the same as was before. It's just because in that other account, we had a side account growing, and this time we don't because we lose those taxes, which is one of the drawbacks with the Roth. You have less money today. That's just a fact. All right, so now we fast forward to our 80, and I did all the RMDs, and I probably missed a couple small things, whatever. Don't get too anal about the exact numbers. This isn't about exact numbers, and the reason for that is because nothing is about exact numbers when we're projecting in the future. It frustrates me how many people get tied up. Well, if I have a 5% rate of return for 20 years, I should have this. Okay, we're off by 30 bucks. Guess what? You're not going to have that anyway. Why? Because you're not going to get a 5% rate of return each and every year for 20 years. You're just not. Unless you're in a government bond, and then you're only going to get 2.5% or 3% or even 4% if you're lucky now. That's it. Other than getting a fixed income of some certain amount, you're not getting this. So don't play just too tight about the numbers. People get really caught up like, well, this shows when I'm 98,000 years old, I have $180,000 in my account. I project I should have 217. It doesn't matter because it's all projections. It's not going to happen. It will be around there at some point, but we have no idea. What we're trying to do in financial planning is get a gauge of what you should do today, your actions today based on what it looks like could happen in the future. But what it looks like could happen in the future, I guarantee will not happen explicitly to what we're showing here today. So don't get too caught up in the numbers. Get the idea in your head of how this works. That way it gives you enough sense to take action. And if the idea in his head, because of the future possibility, doesn't motivate you enough to take action, then don't. So in this case, if the idea of the Roth savings doesn't get you fired up enough, then don't take action because all things are subject to change. With the tax code, rates of return on your investments, whether or not you die, if you get fired, all these things are subject to change, which is why you really need to do your financial plan at least once, I don't know, probably once every couple of years. Once a year, certainly once every couple of years. Certainly when you have any life events. You know, a kid dies, heaven forbid. Kid's born, new grandchild, kid's going off to college, husband has Alzheimer's, blah, blah, I got laid off, just retired, all these different things. When should I take Medicare? When should I take Social Security? That's when you should engage in a financial plan. All right, so now at 80 years old, their RMD amount is 18.7. That's the divisor. So they have to take an RMD off. I had written it down here. Their account value at that point is about 1.37 million, give or take. 1.37 million. They divide that by 18.7. So their RMD amount in this regard is 73,397. That will be their RMD at 80 years old. All right. So now again, married filing jointly. They have 48,000 of Social Security, they have 24,000 each, and we know that 85% of that will be taxable as income. So 40,800 of their Social Security is subject to income tax, plus that RMD amount is subject to income tax, which means their adjusted gross income is $114,000. That's their AGI. You take off your two standard deductions, and their taxable income is $87,597. First $19,000 is subject to 10%. The next, I guess that's $58,000 up to $77,000 is subject to 12, and the amount above 77, and I can't remember the second threshold, but it still is 22%. Excuse me. So I screwed that up, but it's only a couple bucks, so I'm not going to make an issue out of that. At the end of the day, you're paying around $11,000 in taxes as a married filing jointly couple when you're 80 years old. And if you recall before, they were paying a heck of a lot more than that, about double that before, because they had so much in required minimum distributions. All right, now I'm not going to go into the litany of what happens when the spouse dies and all that, just because I think the case is made here clearly. If it's not, that's fine. But I think the case is made clearly that not only do you pay a whole lot less taxes on the back end than you do if you defer on the front end, but there's another thing happening too. Your AGI is $87,000. What does that mean? That means you don't have any Medicare premium surcharges, right? You don't have any, well, you will here, if you have capital gains and dividends, you will still be in a high enough bracket to have to pay taxes on those for sure, which is another reason I say you do some tax planning more so than just waiting until you're 80 years old. But you're pretty doggone close. Now, we haven't inflated the tax brackets, and the tax brackets would be inflated, so this wouldn't be the exact. Again, this is not a science, my friends. Economics is not a science. It's a human relationship capability. Financial planning is not a science. As much as financial planners love using value and was it evidence-based investing and the science behind markets and the science that is stupid. There's no science in this. It's human emotions, human behavior. The science says humans don't act rationally more often than not. And what are you going to do about it? Well, you're simply because we're not robots, not rational behavior creatures, then you have to change course when situation changes. And so we're not doing any of that because we don't know what's going to be. But roughly, we're right there at the cusp of not having any capital gains, long-term capital gains, or ordinary qualified dividends be subject to taxation as well. And so now we know for a fact we are not going to have to pay anywhere near premium for Medicare premiums in a tax, what's called the IRMA, and I can't remember what that stands for, IRMAA. Income-related Medicare adjustment, something, I don't know. IRMA is the taxes that the increase in premiums you got to pay if your income is above a certain threshold. All right. So now, when we're Roth at 80 years old, we got nearly $1 million in the Roth as well. So we got $1.37 million in the traditional, which is taxable as RMDs, as ordinary income. But we have almost $1 million in the Roth too. So what happens is you never touch this money for income. Let that sucker sit. But you certainly tax that money because that will be taxes between you and your survivor and your spouse as ordinary income, but based on 2 tax brackets or 2 standard deductions and a much higher taxable income bracket than it is for a single person, as I just talked about in the last video where I showed you that a single person with significant RMDs is not only in the 24%, which means her and his Medicare premiums are way through the roof, but can get up to the 32 or 35% tax bracket with just a little bit more mandatory distributions. And here we're not going to have that. It's simply not going to happen. Now, with that said, I mean, when the husband dies in this case, because again, we always kill off the husband, you're leaving the surviving spouse with a pretty significant amount of IRA. So you say, for simplicity, let's just say you leave 1.2 million, and let's just say we divide that by 17. That's $70,000 of RMDs right there alone. $70,000 of RMDs though, but now we only have $20,800 of taxable Social Security. So $70,000 plus $20,800, and why? Because she loses one of the Social Securities. In this case, because they're both $24,000, she will lose one of the $24,000s, and 85% of $24,000, I think it's $20,800. So she will have modified adjusted gross income at $91,000. If I get my trusty laptop here, Chromebook, is this a Dell? I'm not sure who did the Chromebook. But anyway, let's see what the socialsecurity.gov says. Individuals with modified adjusted gross income of $91,000 will pay a Medicare surcharge of $53. That's it. So before she was paying a Medicare surcharge of $294. Now she's paying a Medicare surcharge of $53. Plus, she'll pay an extra $13 for her Part D, whereas before she's paying a $75 increase in her Part D. So as you can see, we're talking another $65 in premiums when she gets up this high, whereas before is another almost $400 a month in premiums for Medicare. So that, my friends, is the reason you do Roth. I know there's a lot going on here, but don't get stuck, please, for the love of the good Lord, in your tax bracket today versus your tax bracket in the future. Don't say you can't. I'd even argue at the end of the day, even if your tax bracket is higher today than it will be in the future, it won't be when you're surviving spouse. Now, if you're single, this is different. But remember, 0 to 19,000 is a 10% tax bracket for a married couple filing jointly. If you're a single taxpayer and you have $15,000 of taxable income, you're in the 12% bracket. Let me just go back to this again. And so the tax brackets are they're pretty precise. So if you're in if you have $40,000 of income and you're single, you are in the 22% tax bracket. If you have $40,000 of income and you're married, you're in the 12% bracket. If you have $85,000 of income and you're single, you're in the 32% bracket. If you're at $85,000 and you're married, you're in the 22% bracket. I mean, so you see the difference there. I mean, it gets progressively higher and higher. The more income you have as a single person, the more tax brackets the higher your tax bracket relative to when you're married. There's just no getting around that. I mean, just you think about it, $85,000, you're in the 32% tax bracket, or 24% tax bracket, excuse me, and $85,000, and that's the 22, yeah. Well, that's not that big of a deal, but it can be. In fact, if you look at it even worse, $157,000 if you're married puts you still well within the 22% bracket, but $150,000, $57,000 if you're single puts you in the 32% bracket. All right, so again, the big one is 0 to 19 is 10% for married. 0 to 9,000 is 10% if you're single. 19 to 77,000 is 19 to 77,000 is in the 12% bracket if you're married. Once you hit 77,000, you're in the 22% bracket. And once, I mean, it's just for a single person. It's just it's just bad. I mean, you lose a standard deduction, you're in a higher tax bracket. No other way around that, on top of all the Medicare stuff that goes with it. So that's my sales pitch on a Roth IRA. I think you should do it. I think you should pay a little bit more tax today, but I'll leave that up to you. So as always, thumbs up, comments, questions, concerns. It's been a long video series here for sure, but I hope this gives you something to chomp on. Don't forget to subscribe, and don't forget to go to the blog at heritagewealthplanning.com. We'll see you next time. Thanks, guys.